Hershey. You hear the name, you immediately think of chocolate, right? But is it actually a sweet investment? Well, today we're going to put this iconic company to the ultimate test, the Warren Buffett analysis. We're going to use the principles from the Oracle of Omaha himself to see if Hershey really makes the cut.
So that's the big question we're tackling. Would Warren Buffett, right now, today, actually buy Hershey stock? We're about to dive into a whole bunch of numbers and use Buffett's own framework to see if this chocolate giant has what it takes to land a spot in his legendary portfolio. Let's get right into it.
Now, to figure this out, we're not going to get bogged down in 1,000 different metrics. Instead, we've basically boiled down Buffett's entire philosophy into a super straightforward 3-point checklist. This is going to be our guide, our framework to see if Hershey passes the test.
And here it is, super simple. First, can we actually understand the business? Is it simple? Second, are its financials strong and, just as importantly, predictable? And third, maybe the most important part, is it selling for a reasonable price? We're going to go through these one by one.
Okay, let's kick it off with test number 1. Buffett calls this his circle of competence. Basically, is Hershey a business that's easy to grasp? Is it straightforward?
Yeah, this one's a total slam dunk. Hershey makes and sells chocolate, and mints, and other candy. It's got this incredibly powerful brand that's been around forever. You definitely don't need a PhD to understand their business model, so for test number 1, it is a clear, resounding pass. Easy.
All right, 1 down, 2 to go. Now we get to the really juicy part where we dig into the numbers. It's time to pull out Hershey's financial report card and see what kind of grades it's been getting lately. First up, we're looking at return on equity, or ROE. This is one of Buffett's all-time favorite metrics. You can think of it like a company's GPA for making money. It just tells us how good they are at using shareholder cash to make more cash. And of course, higher is always better. Right now, Hershey's return on equity is sitting at 19.05%. And, on its own, that looks pretty solid. A nearly 20% return is nothing to sneeze at. But context is everything.
And here's where it gets really interesting. That 19% we just saw? Look at this. It's a massive drop from its 3-year average of over 42%. This tells us that even though Hershey's still profitable, its ability to generate profits efficiently has been cut by more than half recently. That is a huge red flag.
Okay, so profitability is one piece of the puzzle. But a truly wonderful company, a Buffett-style company, also needs to consistently grow its earnings. So how has Hershey been doing on that front?
And whoa, this paints a pretty worrying picture. Just look at these numbers. Over the past year, net income is down a staggering 60%. And this isn't just a one-off bad year. The 3-year and 5-year average growth rates are also in the red. This shows a pretty consistent decline in profits, not just some temporary blip. It makes you wonder, right? Are cocoa prices going through the roof? Is competition getting tougher? The numbers don't tell us why, but they are screaming that something is up.
Okay, so the profit picture looks a little shaky, to say the least. But let's look at another number, free cash flow yield. This is all about how much actual cash the business is spinning off. Accounting profits can sometimes be a little fuzzy, but cash? Well, cash is king.
And here is where the story gets a little brighter. This is the bull case. Hershey has a free cash flow yield of 4.48%. Now that's a really healthy number. It shows that even with those recent hits to its income, the underlying business is still a powerful cash-generating machine. And that's a huge point in its favor.
So we've got this mixed report card on financial health, right? But even the greatest company in the world isn't a great investment if you pay too much for it. And that brings us to our third and final test. Is Hershey stock actually trading at a reasonable price?
A classic way to check this is the price-to-earnings ratio, or PE. It's a quick and dirty way to see how much investors are willing to pay for every dollar the company earns. A high PE could mean the stock is expensive. A low one might signal a bargain.
And this chart says it all. Hershey's current PE ratio is a sky-high 44.26. Compare that to its own 3-year average of about 28. That means it's over 50% more expensive than it has been recently. The market is pricing Hershey very, very richly right now, especially when you think about those declining earnings we just saw.
And just to make things more confusing, different valuation models give us totally different answers. If you base it on that strong free cash flow, you get a fair price of around $211. But if you use the struggling earnings per share, it suggests it's only worth about $165. And with the stock trading around $192, well, it's stuck right in that confusing no man's land in the middle.
Okay,
We've run all the tests, we've looked at the business itself, the nitty-gritty financials, and the price tag. Now it's time to bring it all together and fill out that final scorecard.
So here's the summary, the real tug of war. On one hand, you have the strengths, that powerful, simple brand and really strong free cash flow. That's the Hershey we all know. But on the other side, the weaknesses are pretty serious. A very high price tag, consistently negative profit growth, and that sharply declining return on equity.
And this brings us right back to one of Buffett's most famous quotes. So you have to ask yourself two questions. One, is Hershey still a wonderful company despite these financial struggles? And two, is its current price anywhere near fair? Our analysis pretty strongly suggests that the price is anything but fair. And for Warren Buffett, that would almost certainly be a deal breaker.
Look, at the end of the day, whether you would buy Hershey stock or not is totally up to you. But the real point of this whole exercise isn't to give you stock advice. It's to give you a tool, a simple Buffett-inspired framework you can use to think critically about any business that you're interested in. So, I'll leave you with a question. Think about this simple three-step test: an understandable business, strong financials, and a reasonable price. What company comes to your mind? What company would you put through the check next?